I'm going on a bit of a mission today, and I want to make it so that never again will we have this we're in a recession, we're not in a recession argument in the comment section of this channel. Every time we see rough markets, every time we have a couple of bad economic reports, there's this inevitable claim that the recession is already underway. And it's not like I think there's a recession, we might be in a recession. It's obvious. I know that we're in a recession. I think more, maybe it just feels like we're in a recession. The truth, though, is that no one can definitively know if the economy is in a recession until it is officially declared by the appropriate authorities. And that can be tricky. That can really be tricky. There are 4 common misunderstandings about what a recession is. I'm going to talk about those today. They're kind of essentially what a recession is not things. So let's get started with number 1. A recession is defined by 2 consecutive quarters of negative GDP growth. You are going to hear this over and over, but although 2 consecutive quarters of negative GDP growth is commonly cited as a rule of thumb, it is definitely not the official definition. We're going to look at an example of that in just a minute here. It's not even close, actually. It's just something that you're going to hear cited as official. In the US, for instance, the NBER, talk about more about that in just a minute here, considers a range of indicators that go beyond the GDP. They include employment income. They include industrial production. They need that information before they can declare a recession. So no, 2 negative quarters does not equal a recession. The second thing you're going to hear, a recession is always accompanied by a stock market crash. One of the main reasons that investors even care about a recession is, yes, stock market's downturns often occur during recessions, but they are not a defining feature. The stock market can decline without the broader economy being in a recession, and vice versa. For example, the stock market might drop due to specific sectoral issues, investor sentiment, rather than a general economic decline. Number 3, you're going to hear this. Recessions affect everyone and everyone will suffer. Now, recessions can be confusing. You might not feel it as badly as the guy next door, or vice versa. The impact of a recession varies a lot across different sectors, different regions, and different demographics. And as an example, some industries like technology, they might be less affected or they might even thrive, while others like manufacturing or retail might suffer more. Now, the fourth thing here, the start and end of a recession are obvious. A lot of people believe that the beginning and the end of a recession are pretty easily identifiable, but in reality, the declaration of a recession occurs months in most cases after the actual economic decline begins. As well as that, the economy can actually recover in some areas before the recession is even officially declared over. This leads to some confusion about when a recession truly starts or ends. Now let's look at the official definition of a recession. In the United States, a recession is officially determined by one agency. It's the National Bureau of Economic Research. And they define the recession as a significant decline in economic activity that is spread across the economy and lasts for more than a few months. You heard nothing about 2 quarters. You heard nothing about the stock market. This definition considers a lot of different factors, including GDP, income, employment, industrial production, and wholesale retail sales, amongst other things. Now, when we get to Canada, the official definition of a recession follows very similar criteria to those used in the States. However, here the definition is provided by the C.D. Howe Institute's Business Cycle Council. According to the council's methodology, a recession is a pronounced, persistent, and pervasive decline in real economic activity. Not exactly specific, I would say, and this leads to all the confusion that we see out there. I want to look at 4 reasons that I think this is confusing, starting with number 1. There are multiple economic indicators. There is no single metric that actually defines a recession. Yes, GDP is a common measure, but as I mentioned, unemployment, income, industrial output, consumer spending, they also play critical roles. There's different analysts, there's different institutions who might prioritize one indicator over another, and that leads to a range of opinions on whether the economy is in a recession. Now, the second reason is there's a lack of a universal time frame. This is kind of where a lot of people fall back into that 2-quarter rule of thumb. They argue that constitutes a recession. The Bureau doesn't specify specify a minimum time period, as we heard earlier, and that leads to further ambiguity. We've had some very short recessions and we've had some very long recessions. Now, the third reason, there's regional and sectoral differences. And economic downturns may affect certain regions or certain sectors unevenly. That again complicates the recession classification. A recession in one region, one sector of the economy, might not be felt as strongly as in others. And as I noted, a downturn in manufacturing sector that might not impact the technology sector, vice versa. And so when you have this uneven impact, it makes it very challenging to declare a nationwide recession. Now, the fourth reason here, influence of political and media narratives. And especially in today's climate, political agendas, media narratives, they can influence how a recession is perceived and how it is discussed. In some cases, a market decline might be either downplayed or exaggerated, and that depends on the political climate, the media bias, and this adds to the confusion about the actual state of the economy. For example, do you get your news from Fox or CNN, CBC, CTV, or is it all from social media? Depending on where you get your news, you're going to have some very different opinions on whether the economy is doing well or not. Now, I want to look at some examples of some times of economic hardships and do a little bit of analytical work here. I want to start with 1987 with the stock market crash. And if you are old enough to remember the panic that went with the turmoil of 87, you'll remember Black Monday. And in this one day, the Dow Jones dropped 22.6%. And the news was pretty bad. In fact, I would say it was dire. But the broader U.S. economy in this case stayed quite resilient. In fact, we did not have a recession at the time. Let's look at some of the metrics that played out through that time period. If you look at the green line on this chart, you can see that the Federal Reserve did fight back. They lowered rates briefly to cushion the economy. You can kind of see that right in here. But they didn't drop them a lot like we saw this last time around. They actually hovered around the 7% rate. Now, if you look at the white line on this chart, this is inflation. Again, you can see here that it remained under control. At the time, the range was about 4 to 5%, and you can see that held pretty steady through that time. Last chart for this here, the unemployment is the blue line here, and you can see how stable that was. It actually dropped a little bit, around 6%. So as you can see here, there was a lot of bad news, but there was no official recession. In fact, the next recession didn't come until a couple of years later in 1990. Now, I want to look at the next one on the chart here, and that is the 1998 Asian financial crisis. And this crisis led to massive currency devaluations and economic downturns in Southeast Asia, but U.S., Canadian economies actually showed some pretty strong resilience. Let's look at some numbers here. U.S. GDP actually grew by 4.4% in 1998. You can see that on the white line here. The orange line is the S&P 500. You can see the market action, but you can see GDP just keep on trucking along. This next chart here shows the blue line, unemployment, and that remained low, both in the U.S. and Canada, at least low for those times in the 5 to 7% range. There was a lot of short-term volatility in the stock market, but it did recover quite quickly. Again, no recession. Now, the third example, 2011, the debt ceiling crisis. And during the debt ceiling crisis, there was a lot of market volatility. For the first time ever, we saw a downgrade of the U.S. credit rating by Standard & Poor's. But even with all that, the economic indicators remain strong. If we look at some key indicators, GDP growth, it was sluggish, but it was positive, 1.5% in 2011. Unemployment, the blue line here, actually dropped and slowly improved. The stock market was volatile, but it avoided a full-scale crash. So once again here, it sounded like a recession. Maybe it felt like a recession, but it wasn't. Now, one example of official recessions that were kind of unusual in nature was the 2001 recession. And this was driven largely by the burst of the dot-com bubble. Even if you weren't around then, you still, I'm sure, have heard of that. There were huge declines in the tech investment space, with the NASDAQ losing around 80% of its value from its peak. So in this case, the official recession lasted from March to November of 2001. And of course, that coincided with the 9/11 terrorist attacks, which did cause short-term economic disruptions. But when you look at the traditional recession indicators, they weren't actually there. There was one negative quarter of GDP growth, Q3, but there weren't 2 quarters in a row. So that doesn't sound much like a recession, does it? If we look at consumer spending, that's the white line here. It slowed, but it kept moving up. Again, consumer spending is one of those factors they look at. Again, that doesn't sound much like a recession. We saw the same thing here in Canada. The green line is our consumer spending. a bit of a slowdown, but certainly nothing that would make you believe we were in a recession. So in this occasion here, it was an official recession, but some of the key metrics that we think about, they certainly told a different story. So these examples show how nuanced the classification of recessions can be. Various factors, government response, we have the sector-specific impacts, market conditions, all influencing whether an economic downturn is officially classified as a recession. So what do we learn today? Well, there are tons of factors that go into the recession declaration. It is not nearly as straightforward as we would like it to be. For now, though, at least as of March 2025, we are not in an official recession. Thanks for watching. See you in the next video.